Welcome back to Investing Talk Podcast. Today, we're embarking on a close look at a company that's generated a lot of interest and, frankly, a lot of questions. Plug Power. The big thing we're trying to figure out for you is Plug Power a good time to buy now? This company, really a pioneer in hydrogen fuel cells, presents a genuinely complex investment case. It's this mix of huge potential and pretty significant peril. Our mission today is to cut through that noise, look carefully at the key data points you've shared, and really distill the important insights so you can feel well-informed and ready to make your own call. And just before we unpack this, if you find this sort of analysis helpful, please do take a second to subscribe, like, and comment. Let us know. Your engagement really does help us bring you more of these explorations. And hey, if you're feeling extra supportive, maybe consider buying us a coffee. It definitely helps fuel these conversations. Okay, so let's unpack this. Plug Power. We're looking at a company in this rapidly growing clean energy market, which, on the surface sounds fantastic, like an investor's dream almost.
But the overall assessment we're seeing rates it as a speculative buy with high risk, giving it a pretty modest 4.5 out of 10. What's really going on behind this complex kind of contradictory view?
Well, what's fascinating here is exactly that duality you mentioned. On one hand, you look at the current price, around $1.47, and yeah, the stock does seem to show some upside potential. Analysts, on average, figure it could reach $1.83. That's about a 24.7% gain from where it is now. Not bad at all. However, and this is a big the obberer, that optimism is, let's say, heavily qualified. The analysis clearly highlights substantial execution risks and financial risks, too. So you've got this company with real promise, no doubt, but it's navigating some pretty considerable headwinds right now. Headwinds that could, frankly, blow it off course. It's almost like looking at a, high-performance race car, but with a sputtering engine.
Sputtering engine. Yeah, that definitely seems to fit when we look at the financials. Let's dig into those headwinds, especially the raw numbers. What are the financial metrics telling us about Plug Power's performance, about its journey right now?
Well, the financial overview paints a very clear and maybe concerning picture. It's a company struggling hard with profitability. And this is happening while it's pouring money into building out its future growth infrastructure. We saw revenue actually decline 29.5% in 2024, landing at $629 million, down from $891 million the year before. But the real standout number, and honestly the most worrying one, is their gross margin. It's still deeply negative, sitting at minus 99.4%.
Wow. A negative 99.4% gross margin. Just pause on that. For our listener, what does that number really tell us?
Yeah.
Does that sound, it sounds absolutely devastating.
It is. It's more than just a red flag. It's like a financial black hole. What it means is for every single dollar of revenue Plug Power brings in from sales, they're basically losing another dollar just to produce the goods and services they sell. Imagine, like you said, selling coffee for $5, but it costs you $10 just to brew it and serve it. This isn't some temporary blip. It screams deep structural problems in their manufacturing costs, maybe their supply chain. It tells us their core business model right now is just burning cash with every sale. It makes that path to self-sufficiency incredibly tough and very reliant on outside funding. And beyond that specific number, we've seen significant negative net income, negative operating cash flow, negative free cash flow in recent years. Their cash burn rate, how fast they're spending money beyond earnings, is hefty, about $182 million per quarter. Now, compare that to their cash position as of December 2024, which was $206 million. Basic math tells you that gives them roughly 1.1 years of runway. And that runway is literally how long they can keep operating like this before the cash runs out, unless they get more financing or, dramatically cut costs. And just to add to the pile, their total debt stands at $1.08 billion.
That truly sounds like a company walking a tightrope. But you did mention some significant liquidity improvements recently. For many people looking at this, that could be the absolute critical factor, maybe a turning point. Yeah. Can you elaborate on those positive financial developments? How might they genuinely offset some of these, frankly, glaring concerns, or at least buy them more time?
That's a really important point, and it touches on their financial flexibility. It's a crucial bit of hope in the story. Plug Power recently secured two major lifelines. First, a very substantial $1.66 billion Department of Energy loan guarantee. And second, a $525 million credit facility with Yorkville Advisors. These aren't small deals. They significantly boost their liquidity outlook. They extend that runway we just talked about. It provides really critical capital for their ambitious expansion plans. What's also worth noting is their debt-to-equity ratio. It's at 0.62, which, given the debt load, is actually quite manageable, and their market cap currently sits around $1.69 billion. So, yes, operational profitability is a massive challenge, but they have managed to shore up their balance sheet to keep pursuing the vision, at least for now.
Okay, so despite these undeniable financial hurdles, these struggles, what actually gives Plug Power its competitive strengths? Why is it still seen as a leader, even with these big operational challenges?
Well, the company does hold several distinct competitive advantages. These position it pretty well if the whole hydrogen economy really takes off as predicted. First, they are a genuine market leader in their niche. They've deployed over 72,000 of their GenDrive fuel cells. That's across more than 300 customer sites. It's a massive installed base. Second, look at their customer list. It includes blue chip names like Walmart, Amazon, Home Depot, Toyota. These aren't just small pilot programs, they're major commercial deployments. It signals serious demand for what they offer. Third, their business model is vertically integrated. This is key. It means they control or aim to control almost the whole hydrogen ecosystem, from making the hydrogen itself to designing and building the fuel cells, even the refueling setups. Now, theoretically, that end-to-end control should give them better cost efficiencies and quality control, although, as we saw with the margins, they haven't fully cracked that yet. And finally, they have significant manufacturing scale already built out 40 metric tons per day of hydrogen production capacity across 3 U.S. plants. That infrastructure is a big asset competitors would find hard to replicate quickly.
That does paint a strong picture of their market position, their strategic assets. But of course, every market has its contenders. Who are the main competitors breathing down their neck? And what specific challenges, maybe in technology or cost or market share, do they face that these rivals might try to exploit?
Oh, the competitive landscape is intense. This is definitely where Plug Power feels significant pressure. Key competitors include companies like Bloom Energy. Bloom is interesting because it operates with
Okay, let's pivot now to the stock itself. Trading around $1.47 a share currently. What are the valuation metrics telling us? Is it looking cheap, expensive, somewhere in between? And what's the word from analysts covering it?
The valuation metrics really reflect those current financial challenges we've been discussing. Its price to earnings ratio, the PE, well, it's negative. That's not a surprise given they aren't profitable yet. Pretty common for these kinds of high-growth, early-stage companies pouring money into infrastructure. A potentially more useful metric right now might be their enterprise value to sales or EV sales. This gives a sense of the company's total value, including debt, relative to its revenue. At 1.5 times sales, Plug Power is trading significantly below the sector average. So that could suggest the market, despite all the problems, is pricing Plug Power's revenue stream as relatively cheap, maybe an attractive entry point if you believe they can eventually turn that revenue into actual profit. Looking at its trading history, the 52-week range has been wide, from a low of $0.69 up to $3.34. The current price is only about 29.4% of that range, so yeah, definitely closer to its yearly lows. Now, analyst sentiment, their price targets are, let's say, widely dispersed, which really underscores the high uncertainty surrounding the company. The average target among them is that $1.83 figure we mentioned, suggesting about 24.7% upside. But the high target is a very optimistic $4.50. That implies a massive 206% upside potential. While the low target is a pretty grim $0.50, indicating a potential 66% downside, the consensus rating among the, 16 to 23 analysts covering the stock is generally a hold. This huge range tells you there's just no clear agreement on where the stock is headed. It's very much a show-me story right now. Prove it.
That is quite a spread of opinions, from huge potential upside to serious downside risk. What about the technical picture? Does the recent price action itself, setting aside the fundamentals for a moment, give us any clues or maybe warning signs about what might come next?
The current technical setup looks pretty neutral, really mirroring that uncertainty we just talked about. On the plus side, the stock has shown some recent upward momentum. It's up 58.2% in the past month, 17.6% over the past quarter. That looks good on the surface. However, it seems to lack strong volume confirmation. Trading volume has generally been below its 30-day average. That suggests weak conviction behind these recent price moves. It's like the price moved up, but not necessarily driven by a strong wave of committed buyers piling in. In terms of specific price levels, it faces near-term resistance around $1.57. That might be a tough level to break through without more buying interest. Key support on the downside looks to be around $0.74. The Relative Strength Index, RSI, is sitting right at 50.0. That's smack in the middle neutral territory, neither overbought nor oversold. And while current volatility is low, historically, this stock has been extremely volatile. It has a beta of 2.17.
A beta of 2.17. Just to remind our listener, that means if the overall market moves, say, 1% up or down, Plug Power could potentially move more than 2% in the same direction. So for anyone thinking about this, it sounds like it could be a real roller coaster ride. Let's talk about what might push that roller coaster one way or the other. What are the most important recent news items, upcoming catalysts that could really influence Plug Power's path forward? Are there solid reasons for optimism, or maybe lingering concerns we need to keep front of mind?
There are definitely several positive catalysts that could act as significant tailwinds. First, that Senate tax bill extension we touched on. Extending the hydrogen tax credits out to January 2028 provides crucial long-term policy support. That's huge because these incentives are vital for making green hydrogen economically viable, especially in these early stages. Second, that $1.66 billion Department of Energy loan guarantee for hydrogen projects. It's not just about the cash, it's a massive stamp of approval, really. Financial backing from the U.S. government validates the importance of what they're trying to do. Operationally, their Louisiana plant, a 15-ton per day hydrogen facility, was commissioned in Q1 2025. That's a tangible step. It increases their production capacity and should reduce their reliance on buying hydrogen from third parties. The company is also targeting $200 million in annual savings through this internal program they call Quantum Leap. It's aimed at improving efficiency and cutting costs, absolutely critical if they want to tackle those negative gross margins. And finally, a notable sign perhaps of management confidence. Their CFO, Paul Middleton, recently bought 1 million shares of the stock. Insider buying like that is often seen as a bullish signal, suggesting management sees value or positive developments ahead.
Those are definitely powerful potential positives. But flipping the coin, what about negative factors or recent setbacks that might dampen enthusiasm or, increase investor caution?
Yes. On the more challenging side, their Q1 2025 results were a bit mixed. While revenue at $133.7 million actually beat estimates, which is good, their losses of $1.21 per share miss expectations. So yes, revenue is growing, but those profitability issues just keep lingering. They're still facing margin pressure despite trying to scale up, reinforcing that fundamental cost structure challenge. Another recent setback was their removal from the Russell Small Cap Growth Index. Now, that might sound technical, but it can trigger passive selling by institutional funds that track that specific index. It can lead to temporary price pressure, even if the company's underlying business hasn't changed. It basically shrinks the pool of potential big buyers.
Right, that makes sense. And looking further out, beyond the immediate news, what are the key milestones or events we should really be watching for, near, medium, and long term? The things that could truly make or break the Plug Power story.
Okay, new terms. Say the next 3 to 6 months, we'll be watching their Q2 2025 earnings report very closely. Specifically, their revenue guidance they're projecting between $140 and $180 million. Any significant miss there will be noted. Also, progress on their Georgia plant expansion and, crucially, tangible results from that Quantum Leap savings program. They need to show they can actually control costs. Medium term, looking out maybe 6 to 18 months, it's all about the strategic deployment of those big DOE loan guarantee funds. How quickly and effectively can they turn that capital into working assets? We'll also look for signs of international expansion picking up pace, like progress on their allied green ammonia partnership in Uzbekistan. That signals their global reach. Long term, thinking 2 to 5 years out, the entire investment case really hinges on broader hydrogen economy adoption. Does hydrogen truly become a widespread energy source? We'll need to see continued development of things like a national hydrogen highway infrastructure, and most critically for Plug Power itself, finally achieving consistent profitability. Without that, the long-term viability just remains a big question mark.
For our listener considering this investment, understanding the risks is just absolutely paramount. We've touched on many of them. But maybe to bring it all together neatly, what are the primary company-specific risks, the sector-wide risks, and maybe the liquidity risks associated with Plug Power that an investor must be aware of before jumping in?
Okay, connecting this to the bigger picture, the risks are definitely substantial, and they exist on multiple levels. Starting with company-specific risks. Plug Power has, historically, missed financial targets and faced operational delays. This isn't just a minor issue, it represents significant execution risk, which can really erode investor confidence over time. There's also inherent technology risk, particularly around scaling their tech efficiently and achieving cost competitiveness against other energy solutions. Can they actually mass-produce hydrogen and fuel cells cheaply enough for widespread adoption? That's still an open question. Financially, that high cash burn rate we discussed and their ongoing need for external financing means they're constantly reliant on capital markets. That can be tough, especially in a higher interest rate environment. And competition risk is always there. Market share could potentially erode if better capitalized or more efficient competitors emerge or gain traction. Then, looking broader, at the sector and macro level, there's significant policy risk. The company depends heavily on government incentives and regulatory support, like those tax credits. If policies change or get scaled back, it could drastically alter their economics. Market risk involves the pace of hydrogen adoption by end customers. The vision is there, but adoption might be slower than hoped, impacting Plug Power's revenue growth timeline. Economic risk includes the impact of interest rates on big, capital-intensive projects. Higher rates make borrowing and building more expensive. And don't forget supply chain risk dependence on specific rare earth materials or specialized components could lead to disruptions or price hikes due to geopolitics or other factors. And finally, regarding liquidity and volatility, specifically around the stock itself. It remains highly volatile, remember that beta of 2.17. It means potentially amplified swings compared to the overall market, great on the way up, painful on the way down. The recent below-average trading volume might indicate reduced liquidity. That could make it harder to buy or sell large amounts quickly without moving the price significantly. And that Russell Index exclusion could continue to put pressure on institutional ownership, possibly reducing demand from large investment funds.
So putting it all together, what does this all mean? Is Plug Power a good time to buy now? Or is it maybe a situation best watched from the sidelines? After this really thorough look at all the angles, what's the final verdict, and how should different types of investors maybe think about approaching this very complex situation?
Well, the overall assessment holds at that 4.5 out of 10, which translates to a speculative buy with conditions. If we break down that score, its financial health rates quite poorly, a 2 out of 10, mainly due to the negative cash flows and profitability issues. However, its growth prospects are seen as strong, a 6 out of 10, driven by that expanding hydrogen market, even with the execution challenges. And the valuation at these current distressed levels is considered attractive, getting a 7 out of 10, especially if you look at metrics like EV to sales. So how should you approach it? Well, for short-term traders, the recommendation is high risk and honestly probably avoid. The extreme price swings and underlying uncertainty make it unsuitable for quick trades. For conservative investors, it's also a pretty clear avoid. The negative cash flows, the high debt, the uncertain timeline to profitability just doesn't fit a portfolio seeking stability and consistent returns. However, for long-term growth investors, those with a robust 2 to 5 year horizon and a higher risk tolerance, it's considered a speculative buy. It might be suitable for a small, diversified portion of your portfolio, maybe 5 to 10% allocation maximum. This view is based purely on the significant upside potential if the hydrogen economy really takes off as projected. That would validate Plug Power's early mover investments. Now, if you do decide to invest, an optimal entry strategy might involve dollar cost averaging, maybe between $1.25 and $1.40. Buying in small chunks over time can smooth out your average cost. A more conservative entry might wait for, say, a 15% dip down to $1.25, looking for a bottom. An aggressive entry could be near the current price around $1.40, but, and this is critical, with a tight stop loss set around $1.23 to limit potential losses if it turns down sharply. The take profit target, based on that analyst's consensus figure, is $1.83.
You know, what's really striking here is that Plug Power genuinely represents a classic turnaround story, playing out in an emerging high-growth but still uncertain market. The financial challenges are absolutely real, they're substantial, and nobody should underestimate them. But the combination of strong policy tailwinds, the sheer potential size of the hydrogen market down the road, and its current valuation, it really does create what the analysis calls an asymmetric risk-reward opportunity. It's one of those situations where the potential upside, if things finally click, could be significantly larger than the downside risk, although that downside is still very real. It seems it's really for patient, risk-tolerant investors who are willing to bet on the long-term success of the hydrogen economy, and crucially, on Plug Power's ability to finally translate its incredible potential into consistent profitability. So the question for you, our listener, really boils down to this. Are you that patient, risk-tolerant investor? And is the future adoption of the hydrogen economy a bet you're willing to make in your own portfolio?